You guys mind me starting while you're still eating, or you?
Nope, go for it.
Oh, sure. I did not buy it, so don't have to thank me for the money portion, but I did go get it. So.
Appreciate that.
And I don't think anyone would have got this particular kind for you if it wasn't me. So. What's that?
Yeah.
Yes, thank you.
Yes, thank you.
I'm a huge pizza connoisseur, so anytime I find a good place, I'm like, got to do it.
This is a fairly new place. Right?
Yeah, it just opened, I want to say within the last couple months.
Yeah. You know the other place that's really good is that Oak Stone?
Yeah, my wife ate there, yeah.
Yeah.
I've never been there, but she really liked that place.
It's good.
And actually,
Yeah.
the place right next to this pizza place called Sexy Mexi Burritos is also very good.
Okay.
It's kind of a, if you eat in there, it's kind of a, I don't know how you would describe the setting. Like, I sat down at a table, and the table was like slanted, so my food was, and it's kind of real eclectic, I don't know.
It's locally owned and operated.
Yeah, I mean, that's, I guess, all you have to say. It's locally owned and operated. So it's got character, I guess, is what you would say. But the food is absolutely great there. All right, so we're going to get started. And before I talk about the actual material, I just want to talk logistics for a minute. So officially, this is the last day of instruction in the class. The last class we're going to have was going to be for just the final. That's all I had planned for the last class. Not to scare you, it's not supposed to take 3.5 hours for the final, but that's just the way, since you guys were going to be 2 weeks off and then coming back for the final, obviously it was going to be difficult to cover new material in that setting on that last day of class. But I want to propose a change of the schedule for you all. I think I mentioned that I'm going to actually be in Florida the last week that you guys are in class. I was going to do have a person come in and proctor the exam and just have it be a laid-back day where they brought you food and you took your exam. I think Seth is planning to be here to give you all your new books and to do the evaluations. Did he do that on the last day of class, the last 2 classes, or no? How did you guys do your evaluations last time? Okay. So how did you get the book for this class? On one of the classes, or was it the last one? Well, I'll try to coordinate with him, and if I can, then we just won't meet at all that last day of class, and the final will just be a take-home final, if that works for you guys. But, whoa, before you agree to that, there's some stipulations, okay? It's nothing horrible. It's just a slight time commitment more than what I was going to ask of you all. So I've mentioned before how much content I'm trying to stuff into this class. And basically, we're going to finish off covering financial accounting pretty well, pretty much the same level you would get from just a financial accounting class. In some of the background stuff that I've given you already, I've talked a little bit, or you've seen a little bit of just some additional content. I'm going to wrap up the discussion of financial accounting today. We'll talk about that. You guys will work through some problems today, talking about some more financial accounting stuff. Then we're basically going to be out of class time for me to meet with you all. So the stuff that we've met and covered together in class or in the lectures I posted that were substitutes for in-class time. So not the background stuff that was slideshows from classes I've done in the past, but the actual stuff I did for you guys this year. That's the only stuff I'm going to test you on. So any of the background lectures, the synopses, that kind of stuff, that's all just for your information. Hopefully you'll digest some of that and it will help you further along the line. What we've gone over in class, that's what the final will be over. What you've walked through, what I've walked through together with you and then asked you to walk through and then gone through like that. Okay. So the stipulation for the take-home final is that I still have essentially probably 2 classes worth of lecture or material that at this point is again going to be basically for your information. but just the way timing is worked out, that would need to be basically 2 lecture videos. I'm guessing no more than a total of an hour and a half of material that I want you guys to watch. So as long as you commit to watching that, then the final will be take home. That's the stipulation. Are you guys all in accord with that? If you're not and don't want to say it out loud, you can tell me later, and that's fine. We'll work out a different arrangement. But I've also other notes. I've gone in and in the grades, I've put in your grades for participation in homework, which is a de facto 100 unless you do something to lower it. So I assume everyone in here will be at that 100 level when we're done. Even though I've said week to week, hey, I want you to have these readings and lectures watched by the time we start class, the next class, whatever, there's been those due dates. Those have all been just to kind of get you on pace. If there's anything you missed or didn't get done when it was supposed to be done, as long as you do it later, I will send out a final email that last day of class when we would have had class that says, hey, have you done everything that's been asked of you in the class? If at that point, or if by the time you answer that email, you can say, yes, I've watched all the lectures and done everything you asked me to do, then your 100 is preserved for the class. Everybody with me on that? Okay. So I actually deleted the ones that I already sent out saying, hey, have you done week to week the homeworks? I just deleted those assignments. And the only thing that will go in the grade book is what I've already put in there is 100 for all of you guys, and it will stay 100 as long as you answer yes to that final email. Everybody understand? Yes, ma'am.
I do understand that. I want to harken back to the lecture piece, though, and the take-home exam. So lectures 1 through 10 that you have posted, what you're saying is those are not?
Well, I mean, a lot of that, I would say 80% of what's in those lectures touches on what we have done in class.
Okay.
So that most of that has been to inform you, to get you ready, so that what we go over in class makes more sense. Just based on the idea that the more times you hear it from different angles, the better. There's a few things in that is in addition to what we've gone over in class, and anything that's above and beyond what we've gone over in class, you don't need to know for the final.
Okay.
But in addition to that, since the final is take home, and it will be something you can get into and get out of, so it's not have to be at one setting. When you start the final, if there's anything you come across where you're like, I'm confused or whatever, you guys can email and we can talk it through or whatever. Obviously, the only thing I can't do is do the problem for you while you're doing it. Okay? Any other questions?
Thank you.
Yeah? Nothing else? Okay.
When will it be due?
So the final will be due, I'll try to have it done, being made by the end of this week, and then it will be due, I think they're asking me to turn in grades for this class 3 days after the last class, so I'll just have it due probably the day before that. So maybe 2 days after the last class. I don't know exactly what date that is. January 11th?
I think it's 11.
Yeah. I will send you out an email.
Okay.
All of this that I'm saying now I will send back out in email form. So 9th would be the last class. So yeah, I think 11th, if it's done by the 11th, and then I'll turn in grades the next day. Does that work? Okay. All right. So, well, before I get into the inventory stuff, is there anything that you guys want me to go back over or? Yes, ma'am.
Sorry.
No, you're fine.
So it'll be online. It won't be like we'll have to bring it here.
No, it'll be online.
Okay.
Yeah. So you just log in and you'll click the answers and it will auto grade. So, okay. Up to this point in time, is everybody feeling fairly confident that of the stuff that we've walked through together? Obviously, since we weren't together last week, especially anything that I went over in the video last week, excuse me, is there any component of that I need to go back over before we continue on? Or would it be better if anyone has individual questions for me to hit this part, and then when you're working on other stuff, come back around? And does that work better for anyone? Okay. I'll just go through this, and if you have stuff that you want me to cover, let me know when you're working through the problems. So we're going to talk a little bit about, before I get into this, on the lectures that I'm going to post. So up to this point, we haven't really talked a lot about applying these principles to the healthcare environment. I wish that we could kind of have incorporated healthcare more along the way, but just the way that it's kind of squeezing 3 classes into one of those lectures is basically going to be, okay, you have the foundation of accounting. How is all this stuff different in the healthcare world? Or how do I apply these concepts into the healthcare world? So the stuff that you see in the lectures, while I'm not testing on it, that might actually be the stuff that's ironically most applicable to your day-to-day lives. So don't hesitate when you're going through the lectures, even though I'm not going to spend a lot of time assigning stuff and grading stuff out of that material. If there's something that you want better clarification on, or that you just want me to explain, feel free to reach out now or later if the class has already ended, and I'll try to clarify. So we're going to talk today about inventory and cost of sales, kind of not really relevant to, or not as relevant to healthcare, since obviously most of the time when we're talking about inventory, we're talking about companies, merchandisers that buy products that are already made from someone and then go out and sell those products to someone else. So why are we talking about it? Who cares about inventory? Well, for one thing, it's just a huge component of accounting. So if you look at Walmart, which is a giant company that I'm sure everyone is very, very familiar with, and you look at their balance sheet, which again, combined with the income statement is the most important financial statement that people look at, you'd see that inventory makes up 80% of Walmart's current assets. And remember, assets are divided between current and long-term or property, plant, and equipment assets. So even when we look at overall assets as a total group, it still makes up more than 25% of Walmart's multi-billion-dollar, or at least in the hundreds of million dollars, balance sheet. So when you're looking at anything that makes up that big of a component of the financial statements, that means that anytime an outside entity is looking at the finances of a company, a lot of the ratios that they're going to look at, like a current ratio, or just comparing current assets to current liabilities, a lot of the things finance people do to evaluate how well a company does, well, they look at current assets as a group, they look at total assets as a group, and those make up either the numerator or a part of the numerator or denominator of a lot of these financial ratios. So inventory is huge, and it makes up a component of all these things. So if you have rules that significantly alter or tell you how to record your inventory, those are going to be very important rules. Okay? So obviously that's more important for merchandisers because this is on their financial statements. Why is it important for everybody else? Healthcare providers and anyone. Entities that don't have inventory. Well, who here has heard the term FIFO and LIFO before? Most people have heard those terms. If you've not heard them before, after we go over them in class, you'll probably notice hearing them more often. But these are, when you say accounting, or when you talk about accounting, FIFO and LIFO are terms that just come up in the conversation. And FIFO and LIFO, the concept of FIFO and LIFO started in merchandise inventory. So merchandisers, this concept of inventory cost flows, which is kind of what we're talking about today, which is what FIFO and LIFO is a part of, that started out just being what merchandisers used as part of their accounting. And now these concepts of FIFO and LIFO have kind of bled over into all areas of accounting, including managerial accounting, including accounting for instance, in healthcare environments where you're talking about mostly service providers. Anywhere where you're cycling through products, supplies, any type of similar type thing to inventory, these concepts of cost flow assumptions have kind of merged into all of these other areas. So that's kind of why we talk about it, whether or not you're a merchandiser. In addition to that, this class, the way I kind of view this class is I look at it as y'all. I didn't ask all of you to tell me if you were forced or volunteered for this program. I allowed the Fifth Amendment to be pled there, but I look at it as more kind of a continuing ed type program where it will make you all better at your jobs. But in addition to that, you're earning college credits. So if any of you end up going back and wanting to do an MBA at some point, Foundations of Accounting is a class where they'll assume you have a certain amount of knowledge and they will let you out of certain prereqs if that's on your transcript. So this is just one large category of accounting that we have to cover for you to be competent in accounting if you were to move on somewhere else. Okay, so when we're talking about inventory costs, it's important to realize that all of these other components could go into that initial invoice cost. So basically, all expenditures necessary to bring all of these pieces of inventory to their saleable condition and location would all go into the initial calculation of inventory cost. So this is where we start to complicate things. Okay, what is an inventory cost flow assumption? If I just came in here and said, hey, everybody in here, get off your computers, get out a piece of paper, write down what is an inventory cost flow assumption, that's going to be your final grade in the class. Who would feel confident that they know what that is? Okay, these are, if you're not an accountant, and even as an accountant, I don't know what it is with law and accounting. I guess accounting is kind of a subsection of law. But they always seem to write things in a way that's very confusing, when there's probably easier ways to say this. But when we talk about inventory cost flow assumptions, when you hear those words, what should come into your head is FIFO, LIFO, weighted average. Those terms are what goes into the concept of inventory cost flow assumptions. So, well, I'm going to come back to this slide in a second, but I first want to hit the next one real quick here. What's an inventory cost flow assumption? Huh? What are we talking about here? Well, like I said, this concept evolved from a setting where it made a ton of sense to use it and is kind of morphed into areas where it makes slightly less sense but can still be applied. So the example I'm going to give you here is more of the original, why did this ever come about as a concept? So I have this picture here of what are seemingly identical screws. Okay, so you can imagine, and I honestly have no idea how the bulk screw distribution network works, but I'm going to assume that maybe there's some merchandisers that deal in bulk production or bulk sales of these types of hardware pieces to the big box stores like Lowe's and Home Depot and others. Okay, so imagine that you have, for simplicity's sake, an entity that sells these screws, and to be really simple, let's say they make only one size, shape, and kind. And let's say they have, or I'm sorry, they're not making these. We're a merchandiser, not a manufacturer. So we're buying one size, shape, category of screw, and then we're selling it to other people. Okay, so when I say inventory, all that's in my inventory as a merchandiser are these screws. And there's millions of them, right? So imagine for a second, and I have no idea how much these cost to make, but let's say they cost 2 cents to make. So each screw is 2 cents. Imagine how much it would cost to add a serial number to each one of these screws. Okay, probably more than 2 cents, right? What about even just a sticker with the price tag on it, or a serial number on a sticker? Would that be expensive too? Maybe not per item, but compared to the actual cost of the item, and if you're looking at overall costs, it would be both expensive and kind of silly to look at individual screws and track, okay, I got a shipment of 10 million screws, and I want to track screw number 146,246 and make sure that I know that that particular screw cost me 2 cents and I purchased it on December 2nd. Okay? That would make no sense at all to track it that specifically. In accounting, there's always this competing idea of you can get as much information as you want, really, if you're willing to pay for it, but the more detailed the information that you get is, the less valuable it is. So you can imagine having all these screws with serial numbers on them. Not only is that going to be expensive, it really doesn't give you that much information that you might actually need. Okay? So we came up, or merchandisers, or accounting people for merchandisers came up with this idea that has become accepted by GAAP, that as soon as we buy these items, we're going to essentially divorce and separate the costs and the actual physical inventory. Okay? So I will track the costs on a spreadsheet similar to this, where I will track the date that I made the purchase, the units purchased, the cost per unit, and my total costs. Okay? And then I may have just a big room with 10,000 2-inch long Phillips head screws in it. Okay? So in that room, I don't care, and I don't have it separated by the date that I purchased these in the pile of screws. Because when I go to sell those screws, I don't care which ones I grab. I don't care if I grab the new ones, the old ones, it doesn't matter to me. That's the whole reason I'm creating these inventory cost flow assumptions is so that I can do this. So that I can separate and I can have all my inventory in this room because it's all homogeneous, very identical to one another. It doesn't matter how old it is to me necessarily as a piece of inventory. Obviously, this gets more complicated if we're talking about stuff with expiration dates on it. But obviously, you can see a piece of metal that's not going to expire. If some of the pieces that I got a year ago are on the bottom of the pile and they don't get cycled through, it's not a big deal, right? And what that allows me to do, separating that out and leaving this pile of screws and just taking those at will, is I can now look at these costs and I can manipulate how much I'm essentially charging each unit, or how much of the costs of buying these screws, how much am I charging each unit when I sell it. Okay? If you remember when we did journal entries, excuse me, when we provided services or went to sell something to another entity, we had two components to a journal entry like that. We had the component that was a debit to sales revenue, a credit to cash, and that told us kind of the retail side how much we were bringing in. And then on the other side, we had a journal entry that showed inventory going down and cost of goods sold going up. Okay. So basically, whenever as a merchandiser we're selling something, we're tracking two sides of that. We're tracking the amount we're selling it for. Okay, that's our revenue side. But we're also tracking how much it cost us, right? So as managers, that's kind of you may have heard the term cost accounting. It's kind of a synonym with managerial accounting. Because as a manager, the biggest thing that you can control and what you're looking at with accounting information most often is your costs. Okay? If you can see how much items cost, you can make decisions on how much to charge for that item, decisions on how well you can market that item. All of those decisions end up being based on the cost of that item. So this is this inventory cost flow assumption using FIFO and LIFO and weighted average. This is a way to take and kind of rearrange when I'm recognizing these costs. Okay, I know this sounds really confusing right now. It is a confusing concept, but let me show you. Okay, back to this one. Told you I was coming back to this one. Okay, when we talk about inventory, FIFO, LIFO, and weighted average are just a way for us to change when these costs are recognized. Okay? FIFO stands for first in, first out. LIFO stands for last in, first out. And weighted average, obviously, is a weighted average. There's a fourth one called specific identification, which basically just means ignore these cost flow assumptions and put a serial number on every item. Okay? If you were doing that, that is specific identification. But using these cost flow assumptions, that would be either FIFO, LIFO, weighted average. First in, first out just means, okay, if you have this pile of inventory, and though costs don't reflect actually what the screws would probably cost here, but assuming we're talking about that example again. So these numbers are the number of screws going into the room that's got the pile of hardware in it, right? And these total costs are the amounts that we paid for these screws to get them into our area ready to sell. Okay? Inventory cost flow assumptions don't change any of these numbers. All they do is they change when this amount here, which is your total cost of inventory, when that amount will show up on the income statement. Because when you buy inventory, just like I have in this slide here shown, when you buy inventory, this is just an asset for asset change. You have a debit to inventory, a credit to cash. Again, this is just like changing out one type of money for another, right? Gold, silver, monies for or a dollar for euros. These are just one asset for another asset. Okay. So as Walmart, if I go out and buy 1,000 TVs to sell to other people, that's not an expense to me until I actually sell those items. Okay, let me say that again. When Walmart or any merchandiser goes out and buys items to sell, that is not recognized as an expense until they sell those items. Okay? Until they sell those items, this point right here, all of those costs are captured in the inventory account. So they're just being, it's just your assets growing. These inventory assets grow as you spend money on them. Okay? And that account grows because these accounts are just holders of value. So what that account is holding is it's holding all of the value that you've invested into this inventory product that you're going to sell. Then when you sell it, it becomes part of cost of goods sold. So the journal entry that lowers your inventory increases your cost of goods sold because you're just flipping whatever amount you sold goes from inventory and becomes cost of goods sold. So, going back to this slide, assuming these are all my purchases, recording my purchases doesn't change no matter what method I use. Okay? These cost flow assumptions begin to arise once I start selling items. Okay? So let's assume that this happened, and I went and sold 1,500 units on February 17th. So I've already purchased all of these, and I go and sell, how many did I just say, 1,500? Yeah, 1,500 units after all of this has taken place. Under the three methods that use inventory cost flow assumptions, let me explain how this works. Okay? So, again, the actual items are separate from this. We're just talking about looking at costs and assigning these costs to the items when they sell. So imagine this is how it works. Got my room full of product here. A sale happens. I go scoop up the product. I ship it and sell it, and I say, hey, I've just sold 1,500 units. Now I want to know how much those units cost me, because however much those units cost me, that's the amount that will flip from inventory to cost of goods sold. Okay? So, based on FIFO, LIFO, or weighted average, I'm going to use those selections, whichever one I choose, to determine, because as you can see here, there's various different price tiers, right? There's 4 different purchases I made where the unit cost was different for each purchase. So when I go to sell my 1,500 units, which one of these costs per unit do I use? That's where the cost flow assumptions arise. How much do I assign as a cost to each unit as it goes out the door based on the purchases that I make? Okay? At the end of the day, I have to assign this full value of cost because that's how much they cost me, right? I can't change that. At the end of the day, I have to assign that full value of costs whenever I sell all of these products. The only thing that I'm allowed to manipulate based on acceptable GAAP accounting is initially when I start my business, I can choose to set up using FIFO, using LIFO, using weighted average, or specific identification. Okay? So, what does that mean? Well, if I use FIFO, that means on February 17th, when I go to sell 1,500 units, I will look at my list of inventory purchases, and I will start at the oldest, my first purchase that's still in inventory, which is this top row, and I will use up as many of those units that are in that tier as I can before I run out. So of my 1,500 units, I will assign $5 costs to the first 1,000 of those. Then the next 500 units will pull from this group. Okay? So of my 1,500 units that I'm selling, I will say 1,000 cost me $5, and the next 500 came from this tier and cost me $5.25. So I'm basically pretending that in my inventory room, I have these lined up in the order that I actually purchased them in, and I am selling them oldest first. Okay, that's the accounting fiction that we're pretending that's going on. But that's, again, the whole reason we did this is so we didn't have to keep track of what was actually in there. So that's FIFO. Start with the oldest and work your way down. Okay? And for that reason, since FIFO and LIFO either start at the top or start at the bottom, when we list out our purchases, we always list them out in chronological order like this, so that you can either start at the bottom of your list and work your way up, or start at the top and work your way down. So LIFO would just be the opposite. Of my 1,500 units, instead of starting at my oldest units first, I will start at the newest units, and my first 1,000 units that I sell will cost $5.40. Again, remember, this is not how much I'm charging to other people for them. This is how much I'm saying it cost me. So the first 1,000 units at $5.40, and the next 500 units would then come out of this row. Okay? So, what that means is, as you're doing this, what's important to remember is, okay, in this example, I've made it a lot easier because I did all my purchases first, and then I started talking about the sales after that. In reality, it's going to be like a couple purchases and a sale, a couple purchases, sale, etc., etc. So it's going to be in and out. So what's important to remember is, as you go over here, you want to make sure that you're crossing out and saying, okay, I used up that 1,000, and so now that's gone. I used up 500 of these, and so now that's gone. So at the end of the day, no matter which one I used, either FIFO or LIFO, because of this concept, the fact that inventory and cost of goods sold are kind of two sides of the same coin, that means that that full amount of 26,002 is going to be divided somewhere between inventory and cost of goods sold. Whoops. So, no matter which method we use, all that we're saying is, okay, with FIFO, you might have slightly more on the inventory side, slightly less on the cost of goods sold side this year. But by the time you sell all of your products, they will even out at the end. Okay, so none of this would be relevant at all if each period we started with a zero balance and we sold off all of our inventory by the end of the year. If we did that, there would be no need for cost flow assumptions, okay? Because at the end of the day, if you sell all of your inventory and all of this has become cost of goods sold, there's nothing to do with the cost flow assumptions. All those do is they basically allow for there to be some slight differences that are called temporary differences year to year. Okay, so if you compared two companies that were absolutely identical, but one used FIFO and one used LIFO, for some of the years their numbers would look different. If they had the exact same lifespan, at the end of their company's lifespan, if you totaled up and did a financial statement that covered the whole lifespan of the company, at the end of the road, the two lines would eventually be the same. Because, again, we're not changing total cost of inventory here. All we're doing is saying how much of this will go on year one's income statement, how much will go on year two's income statement, etc., etc. Okay? Remember, nothing goes on an income statement until you recognize it as an expense from the expense side, and the biggest expense account that there is, one of the few that doesn't have the word expense in it, is cost of goods sold. Okay, so that's FIFO and LIFO. The other major one, other than specific identification, that we'll talk about quickly here is weighted average. Okay, and what weighted average does is, here we go. Let me move that over real quick here. Sorry, I'm just trying to get this all on the screen here. Oops. All right, now I'll move that one out of the way. Basically, what weighted average does is it, like the name says, gives you roughly the average cost of your inventory. So looking back at this spreadsheet type slide again, essentially practically speaking, the way that weighted average operates is anytime you buy inventory, you would go in and calculate what the average cost is. So let's assume that this, again, is inventory I've already purchased, and I want to know February 17th, if I am selling 1,500 units, how much should I sell each unit for? Well, technically for weighted average, each time I bought new inventory, I would recalculate what my average was. So after the first purchase, obviously my average is $5 per unit. After the second purchase, if you combine those together and found the average, you could get an average cost there. But since we don't sell anything between the second and third, it's kind of irrelevant to us. And the same story holds true until we get all the way down here. So now we're getting ready to sell something. And because of that, we're going to want to know what the cost per unit is of the items we're selling. So all we would have to do is take the average cost, which would just be our total, 26.2, divided by the total units, 5,000. I don't have a calculator in front of me. Anybody have a calculator you want to do that?
24.
What is it? 520, you already did it? Here's some math whiz. You're a math whiz, huh? Well, I will trust you will say 524. And you can see that that is roughly within the realm of what you would expect based on the average there. And again, that's a little bit oversimplified here because we have all of the purchases done before we do any of the sales. In reality, the way that this would operate is, we'd have the first two purchases, and then we would find the average. Let's say we made a sale at that point, and excuse me, if at that point it was like $5.18 per unit, then we would say, okay, we have 3,000 units at $5.18 or whatever it is per unit right now. If we went out and made a sale, that's how much we would charge, $5.18 per unit. Until such a time as we went out and bought inventory again, at that point we would calculate the average again of whatever remaining units we had left, plus the new ones we got, and that new cost per unit would be our average cost until we went out and bought inventory again. Okay? Is that making sense to everybody? Kind of? It'll make more sense when we walk through it. Yeah?
Does weighted average, in your experience, do you see there's balance sheet issues?
What do you mean?
So, like when you're using, say, 518, when you go to reconcile your assets and liabilities, I mean, at the end of the year, I end up having...
Like rounding issues? Is that what you mean?
No, I have like my inventory doesn't balance out to my cost of goods sold because of weighted average. Is that normal or not normal?
It's not normal, no. I mean, you would occasionally run into some rounding issues because each time you calculate the average, if you're rounding at all and it's multiple, hundreds or thousands of units, I don't know what specifically you're talking about. You can see how that would slowly start to skew it.
Well, we have significant fluctuations in both pricing, so...
Yeah, I mean, the way that the weighted average is calculated, there really shouldn't, there never should be an issue of them not balancing. You have total costs, and then you have that divided somehow between inventory and cost of goods sold, right? So is that what you're saying is not, like total cost doesn't equal inventory? Yeah, that's not right. Something's wrong there.
Good to know.
Yeah.
It's all here.
Yeah, I have to look specifically at what it was to see exactly what, but yeah, that should never.
So weighted average doesn't cause balance sheet issues.
And it shouldn't on its own. Okay. It may, the only slight issue that may come up, like I said, would be a rounding one. So if you're off by more than what would be attributable to rounding errors, then yeah, there's something else wrong. Yes, sir.
Is there a better time, like depending on the size of the company, that this size should use first in, this size should use last, this size should use weighted?
Let me back up a little bit and say this is kind of a weird area of accounting because there's not that many things that under GAAP you have a choice that allows for such different possibilities. Because one of the main underlying concepts of GAAP is consistency, right? You want to be able to apples compare everything that you look at. This is an example of something that they're specifically allowing that is going to give you an apples to oranges type of comparison. So with that being said, there are ways to kind of game your selection depending on the size and I would say where you are in the growth of your company. So if you were, because basically making the choice between FIFO and LIFO, you're basically deciding in periods of inflation, which is most of the time, obviously things will be more expensive as time passes. So if you are using LIFO, for instance, then you're going to get the most expensive stuff right now, which would lower your net income right now, but also lower your taxes right now. So that typically the management decisions that go into selecting these are trying to determine at the outset, does it make more sense for us to recognize more income in the short term or the long term? Like I said, under all of these, long-term wise, they're equal. At the end of the day, 26.2 is the cost of all of these goods. But short-term, they can obviously do some substantially different things. Because of that, though, you can't flip-flop year to year, right? So you make a selection, and you're stuck with that unless you have compelling business reason that you can go and say, hey, this is why we're changing from FIFO to LIFO because it makes more sense, or it's just more feasible economically, or I don't have a great example of, I mean, it happens. People do it. But typically you're stuck with what you get. So, yeah, I mean, it depends whether your goals are, if you're, let's see, I'm trying to think. Like if you're in a growth phase, you don't really care about necessarily putting out there a really high net income because you're really concerned with growth, right? So it'd be a lot more important to you at that phase to pay less taxes and have more money that you can put back into the business than it would be to increase your net income to make it look good for investors, right? So depending on where you are in the life cycle of your company, you may have different goals. But at the outset, yeah, I guess I should point out here that a lot of companies are making this decision when they're deciding to go public or right before they're deciding to go public because a lot of them, or some of them at least, have not had to do GAAP accounting before then. So, when I talk about life cycle, you may say, well, aren't all of these in the beginning of their life cycle because that's when they're making the selection? But, really you're making the selection whenever you start doing GAAP accounting, not necessarily when the company is started itself. Does that make any sense? Okay. All right. Moving on to our example. Okay. So we got Laker Company reported the following January purchases and sales data for its only product. Let me talk real quickly about perpetual versus periodic, just because it's going to be, the terminology will be brought up. There are two different systems of keeping track of your inventory, one called periodic, one called perpetual. Perpetual kind of has taken over the world now that computerization and electronification has become so mainstream and so cheap. But basically, perpetual inventory systems are those that keep track of your inventory as you're going, basically. So when a unit is, picture like Target. When they sell something, it goes across the scanner, it gets rung up, but at the same time, the computer automatically deducts that unit from their inventory system. That's a perpetual system because as you make the sale, the computerized system automatically deducts that from your inventory count. The other side is periodic, and that just means instead of keeping track at the point of sale or as this is going, the only way that you know how much inventory you have is you have someone that goes out and physically counts it and says, okay, this is what you started with, this is how much is left, so you must have sold however many units. Okay, so that's periodic. You can see how obviously periodic is kind of outdated simply because you're relying on humans, and humans make errors, and humans want money. to do work, so it's expensive. That being said, even with the perpetual system, there is still a human count of inventory, at least yearly, done, where obviously they're having to look for theft or damaged goods, etc., and just to make sure that the inventory that the computer's keeping track of agrees with what is actually there. So when you see perpetual listed here, that's kind of just the assumption. We're going to assume pretty much everybody is using a perpetual system now, just because in the past, the barrier to using a perpetual system was just cost, and now it's just become so cost efficient and I don't want to say overall cheap, but cheaper than it used to be to do that. So pretty much everyone that it makes sense to use a perpetual system uses one. Okay, so everything I've described to you so far about FIFO, LIFO, weighted average, that's all assuming this perpetual system here. Okay, so what we're asked to do here is determine the cost assigned to cost of goods sold using all four of these methods. Again, specific identification just means, hey, we know exactly which unit we're selling, and that unit we've tracked the cost and the timing of when we bought that unit, and so as we sell the unit, we know exactly which unit we sold. And then, like I said, FIFO, LIFO, weighted average are what we already talked about. So for specific identification, we have the list there. That final statement there just tells us which categories of inventory or which cost bands we made sales from for specific identification. And actually, when I have you guys do this, I think the question asks for specific identification there too, but we're just going to focus on FIFO, LIFO, and weighted average. So under specific identification, all we do is go through, like I said, and we know this is my inventory bands, basically. We've got these 3 purchases made. Each one was made for a different cost. And over here, of those, we're told, okay, so of those 140, I sold 125 of that group, 55 of this group, and none of that other group. Okay, so again, we're given the unit costs here of this group. Since I sold 125 of those units, multiplied times the unit cost, that gives me the cost of goods sold from that band of inventory, and from that one, and from that one, total cost of goods sold here, and together with what I have left in inventory should give me my total there, 1950. Yes, sir.
If you're using FIFO, wouldn't you use all 140 units first before you went into the second purchase? Like you used 125 out of 140.
Right, yes. So if you're using FIFO, yes, you'd use all 140 before you came down into the 160. And the only reason we didn't do that this way is just because they wanted to show you what specific identification looks like. Yes. And again, once we calculate cost of goods available for sale, which is just everything we purchased here plus our beginning inventory, that's the number that, again, no matter which method we use, should equal inventory plus cost of goods sold. All right, so now we're going to use weighted average. So we've got our first 140 units. And again, like I said, every time we make a purchase, we will recalculate our hold on a second here. Yeah, so we only had the one purchase before we made our first sale. So obviously with the first purchase, no math needed. Average cost is just what the unit cost was. So we'd take 100 of those 140 units, leaving us 40 left. Then we come and we purchase some more. So now, since we just purchased some more, we're going to take this 40 units plus this 60, so that would be 100 units. And then we're going to take this $240 plus this 300, which is 60 times 50, and average those together. So now, since we have 100 units, 540 total cost in inventory, that means our unit cost would be 540. So our next 80 units that we sell on January 25th will be at that price. 80 times that gives us our cost of goods sold. That leaves us 20 units. Those 20 units will be at that $5.40 per unit cost. Gives us $108 left in inventory. We make another purchase, so now we have these 180 units times 450 plus these 20 units times 540. Divide that whole amount by 200, and that gives us, well, I guess since we're not making any other sales, we don't need to know the unit cost, but if we did, it would be 459 there. Okay, and again, that gives us cost of goods sold of $1,032 with an ending inventory of, of 918. Any questions on that one?
Would it be possible to just walk through that again?
Yeah. This is probably the definitely the hardest of the four here is the weighted average. So. All right, so let's go through this again here. First, we'll go through it looking at these dates up here. First action that happens here is on January 1st. We have beginning inventory that was acquired at this cost. So we'll put that on there, okay? Over here, this inventory balance, that should just be our carrying amount of whatever we have left in inventory. So as of right now, that's just these 140 units. And since those are all that we have, obviously the average of that is just that price. You with me there? Okay. As I'm going through this, holler when I lose any of you, okay? So next, looking at my timeline up here, our next activity is January 10th. We have sales. We sold 100 units at $15 a piece. This amount here, that's, if we were actually doing the journal entries, we would need to know that amount. But for the purposes of this exercise, that's just telling us, hey, you sold this amount for this amount, okay? All we really need to know there is we sold 100 units. So we come down here, and our job here is to assign a cost to each of those units that we sold. Since we've already figured the average, and that average is $6 per unit, those 100 units will all have that $6 per unit cost. So when we sell it, and those amounts transfer over from the inventory account to the cost of goods sold account, it will be at that rate, $6 per unit. So $600 will go over to the cost of goods sold as soon as this first sale is made, meaning that that's $600 that came out of your inventory balance. So your remaining balance is this $240, which is consisting of 40 units at $6 per unit. Everybody still with me? Okay. January 20th, we make another purchase of 60 units at $5 a piece. So now we have basically two bands of price within our inventory. We have these 40 units at $6 a piece and these 60 units at $5 a piece. And we're now going to calculate the average of those two. So we will add the 40 plus 60, and that will give us 100 total units. Then we will add the 240 plus 300, and that will give us 540 total dollar value in inventory. So we will divide the total dollar value in inventory by the number of units in inventory, and that will give us our cost per unit of $5.40 per unit, which really should have gone right here just to show us. Okay? So then the next item that happens is January 25th, we go and make a sale. So we write that in here. That's 80 units, $5.40 per unit, which is what we calculated right here. So that we're taking, of these 100 units, we're taking 80 of them away and selling them. So 80 times 540, that's how much is going into cost of goods sold, which again is important only because as soon as it goes in there, that's when it shows up on the income statement. Okay? So that means that we have used up 80 of these 100, and so what we have left is 20 at 540 per unit. And our last item of business is making a final purchase of 180 units at $4.50 a unit. And so that leaves in our final inventory these 180 that we just purchased plus these 20 that we had left over, which is what I'm dropping down right there. This one at $5.40, these 20 at $5.40 a unit, and these 180 at $4.50 a unit. Sum those up, and I have 200 units. Sum those up, I have 918. Cost per unit is $4.59. So if I don't make any more purchases, the next sale I make, the cost per unit to me will be this $4.59. Okay?
So what would happen if, between January 20th and January 25th, if you had another sale?
Okay.
Do you put weighted average on top of that as
Wait,
well?
so before this sale, I make another sale. Is that what you're saying?
Yes.
Okay. So
No, I'm sorry. I had that backwards.
after the sale.
No, let's say that you make another purchase
Oh,
between January
20th and 25th.
Yes.
Okay, yeah. So in that case, this 540 would never be a unit cost that I assigned to an actual sale because instead of calculating it based on this total, I would have another set of units that would go right here and another cost that would go right here. And I would then, remember, every time you buy more units, you recalculate the average.
Okay, that was a missing.
Okay, yeah. Every time you buy more units, recalculate the average. That average stays the same no matter how many sales you make with that average. You can sell all the units and it will stay that cost per unit. That the weighted average cost per unit will not change until you make another purchase of units.
I think my question comes in right here is, so your units acquired at cost, that's actual.
Actual costs.
1950.
Yep.
But when you go to sell it, it's an average.
Right.
So they don't equal.
Well, right, but they do equal when you're talking about all of the units that you used. Right, so I see where your confusion is.
The cost don't come out.
Right, they will though if, so I see what you're saying. I see what your confusion is here. It's not super obvious that when you add up the total costs of goods that you have assigned based on the, I assigned $600 based on this unit cost, $432 based on this unit
Those are
cost.
actuals.
Those aren't actuals, those are weighted averages, right? And that's why you're saying,
They don't
well,
come
since
out.
that.
Yeah.
But, okay, doing it this way, okay, that will still, remember, all I'm doing is averaging. To get to this number, what am I finding the average? How am I finding the average? I'm taking the total costs divided by the number of units I have. Okay? So that means that every time I do that, the total costs that I have to divvy out are being divvied out between the units, right? Okay. Every time I purchase units, I'm redivvying every cost between the units. What that means is, at the end of the day, once all units are sold, then total cost to purchase units will equal the total that has gone into cost of goods sold based on these average costs.
Yes.
Okay. Until then, it won't. So if that was that what your question was related to earlier? Yeah. So there may be a temporary difference, but what you're not seeing there is, okay, no matter what unit cost I assign, okay, these unit costs, all they're doing is that unit cost is pulling some amount out of inventory and into cost of goods sold, right? At the end of the day, the full amount that's in inventory will come over into cost of goods sold, right?
So basically, to prove it out, if you sold 200 units, that would wipe out your inventory. Your cost of that would be 918. If you add 918 to 600 and 432, it equals 1950. So you're, as long as you sell everything for that
Right.
same time period,
Yeah, I guess that's.
it matches.
The math, yeah, the math proof.
Is the average of what you've spent.
But would you never go to deplete your inventory?
No,
You
that's-
don't, yeah.
Yeah, that's where I'm running the problem.
If
In
you
real
fully
life.
depleted it in the time period, like I said, all of these would be equal. There would be no difference. You could say you were FIFO, LIFO, weighted average. Your financial statements would all look the same. Because at that point, it doesn't matter. The only time it matters is, okay, we're arbitrarily introducing some stopping point by saying we're doing financial statements December 31st. So as of that stopping point, we have horses are at different spots in the race. If you wait till the race is over, they'll all cross at the same time. But until then, they'll
So
change
it's the end,
position.
it's the end of year reconciliation that
Yeah.
causes problems.
Yeah, okay,
Well,
yeah.
and we're not talking about 40 cents here.
Yes.
We're talking about thousands
Yes.
of dollars in that weighted
Right.
average, because you might have bought an item at $100 on January 1 and $500
Right.
on January 20th. So we're not talking,
Yeah.
we're talking a huge span
It's
of
huge
average.
discrepancy. And that only adds to the differences that you will see between these methods in comparing entities.
Weighted average.
But inventory and cost of goods still matches.
It's, yeah,
Right.
no matter which method you use, they will
I
always
get
match.
that now, but at the
You
end
can have wide swings.
You can, but at the end of the year, when you're trying to reconcile some, or make up your financial statement for that year and to match up all costs for the year and all costs of goods for the year, your inventory that you have bought and the inventory that you sold, sometimes it doesn't match up.
It
with
isn't,
the
yeah.
inventory.
If you, I think what Scott's saying is if you did the proof like he's talking about, it would always match up. Mathematically, it will never not match up. But what you're talking about is you're just, based on the paperwork you're doing or the functions that you're doing, the temporary differences that come up are just coming out, and you're seeing those, and that just gets highlighted through that process. Is everybody somewhat comfortable with this, at least enough to give it a shot on your own? Okay, so the next part, oh wait, I didn't even, did I sound too excited about that? Sorry. Let me walk through these FIFO and LIFO, even though they're pretty simple here. So again, we've got January 1st, same beginning inventory. This first line should be the same for all of the methods that we use. January 10th, we're going to sell 100 units, and those are all going to come out of this band. So again, that's just going to be $6 per unit. That will be identical for at least weighted average LIFO and FIFO. Now when we come back down to January 20th, selling 60 units. Let's see here. Or no, I'm sorry, purchasing 60 units. 60 units at $5 per unit. That will just go over into our inventory in chronological order, making sure as we go that as we're tracking these over here, that they still stay in chronological order so that I can just work my way from top to bottom here. We have my totals here. Again, totals between inventory and cost of goods sold should match up. I go to sell another 40 units. We're still within this 140 original units because I only sold 100 of those. So I still have 40 left over. So that next 40 units that I sell will still come out of that $6 batch. That will leave 0 within that cost band. And all 60 of these $5 units will be what I have. Or I'm sorry. Then I had another 40 units that I needed to sell out of that batch because I was selling how many here? Oh yeah, 80. Sorry, 80 units sold here. So I used up all 40 of the $6 batch, and then of the 60 units in the $5 batch, there should be 20 left, leaving my ending inventory balance there at $100. Then I come down and make my final purchase. And that just goes over into my inventory. Okay. Just for the sake of knowing what's going on here, we have included this $6 band, even though there's nothing in it still, just so we know that it's there. In reality, that would not be included. As you drop down, you would just eliminate that band, and all I would see here is the 20 units at $5 per unit and the 180 units at $4.50 per unit. And again, critically important that I have listed these in the right order so that I can just start at the top and work my way down. Obviously, with only 3 different cost bands here, it's not a big deal. But if you put them out of order and you have maybe 30 different bands that you're looking at, then we start getting more complicated. But again, same thing holds true as far as inventory versus ending inventory versus cost of goods sold, adding up to our costs of goods available for sale. And then LIFO, same thing. First 2 lines identical. When we make our first sale, now instead of starting at the bottom, we'll use up all 40 of these $6 units. Then we'll use 60 of we'll use 60 of the $5 units. These were not showing up over here for some reason. Oh, yeah, sorry. Whenever you're up here doing the PowerPoint, your brain just does not work. I'll tell you that right now. Okay, so we've got in our inventory 100 units, total cost $540 there. As of January 25th, we go to sell another 180 units. 60 units. I keep wanting to look at this group. Let me just go back there right now.
Yeah.
Yeah, what the heck? I did not build this, by the way. This was just from the book's presentation.
Your last ones in on January 10th were the ones that you bought on January 1st.
Yeah. That's our only, again, for
That's
these,
the only thing you have.
under LIFO, weighted average FIFO, these first 2 lines will look the same under all of those categories, right? So, yeah, it is a kind of a trap here. So, that was your only question on the 10th?
Yeah.
Transaction? Okay. All right. I'm going to slowly go through these here so I don't confuse myself. January 20th, we make another purchase of 60 more units at $5 a piece. So now we should have 40 units at $6 a piece, 60 units at $5 a piece. And that's what we have. Okay, good. Now my brain's back on. Okay, now January 25th comes around. We make 80 sales. Of those 80 sales, we start at the bottom. So 60 come out of this group. 20 would then come out of the next group up. Okay, so that means within the $5 band, I have 0 units left because I used all 60 of those up right here. Within the $6 band, I had 40 units. I used 20 of them up here. I have 20 left. 20 times 6 gives me my ending inventory value there. January 30th rolls around. We just make our final purchase, and it just slides over there to take its place on my ending inventory. Then again, whenever I started to sell again, I would start with these 180 and work my way up. So you can see this $6 unit, as more time passes, the chances of even hitting that get slimmer and slimmer as you go. That's one of the big issues with LIFO, is you can end up having some stuff there that just sits there and never cycles through. So actually, there's some restrictions. We won't get into the nuts and bolts of this, but for tax purposes, you're not allowed to use LIFO even because of that. And there are some other restrictions. But for financial purposes, financial accounting purposes, I should say, it is acceptable. Okay. Anybody have any questions on the operation of FIFO, LIFO, weighted average?
So for FIFO and LIFO, with your ending inventory, you never worry about a unit cost? No. All I care about is the total value there, and I care that I have them arranged by units in these tiers. But as far as final reporting, no, I don't care about a final unit cost there. As long as the total cost of goods sold out of inventory equals your total cost, product cost.
You're good. All right, you guys good with that? Bless you. All right, now it's your turn. Okay, in Canvas, I've got the document on there. It says, I think it's something similar to that, December 19th, your turn. And it is doing the very same thing again.
Uh-oh. Like you.
I'll move fast.
Oops.
Oh, it wasn't there when I left. When I